You're sitting in traffic at 8:41 a.m., coffee going cold in the cup holder, radio talking about markets at all-time highs. You check your phone. Your trading app flashes red, down $1,247. Again. You sigh, lock your phone, and tell yourself the lie everyone tells themselves. It'll come back. Then you get to work. Same desk, same salary, same badge swipe. And during your lunch break, you see it. Your old college friend posts a screenshot. Close my positions. Another great month. Stock market profits. Calm smile. No hype. Same age as you. Same starting point. Same economy. Same market. So why does it feel like the stock market is rewarding them and punishing you? Are they smarter, luckier, insider info, or is the game completely different from what you think it is? Because here's the uncomfortable truth. The stock market is not a place where money is made equally. It's a system that quietly transfers money from impatient people to disciplined ones. And today, we're going to talk about how money is actually made in the stock market, and why most people lose even though they think they're doing everything right. Let's start with the lie, the one that traps people for decades. The stock market is about being smart. It's not. The stock market is about timing. Nope. The stock market is about picking the right stocks. Still wrong. The stock market rewards behavior, not intelligence. And the reason most people lose money isn't because they don't know enough. It's because they're playing the wrong game. Let me introduce you to two people. Person A, Daniel, 28 years old. He makes $70,000 a year, no finance degree, no fancy strategies, drives a paid-off Toyota. Person B, Chris, also 28, also makes $70,000, obsessed with markets, watches charts daily, drives a new car with a monthly payment. Both invest in the stock market. Both think they're investors. But they are not playing the same game. At age 35, Daniel has $148,000 invested. Chris has $41,000. Chris isn't worried. Markets are volatile. He'll catch up. At age 45, Daniel has $520,000. Chris has $96,000. Chris starts switching strategies. New indicators, new stocks, new systems. At age 55, Daniel has $1.6 million. Chris has $230,000. Chris Googles how to recover retirement after bad investments. At age 65, Daniel retires. Comfortable, calm, free. Chris is still working. Same salary, same market, same opportunities. Different outcomes. So what happened? Daniel didn't trade. He didn't chase returns. He didn't outsmart the market. He did one boring thing. He invested consistently into the stock market and then left it alone. Chris? Chris tried to win. And the stock market doesn't reward people who try to win. It rewards people who don't get in their own way. Let's get brutally honest. Most people lose money in the stock market for 3 reasons. They treat it like a casino. They believe speed equals success. They underestimate time, and all 3 feel logical in the moment. Reason number 1, the casino brain. When you open a trading app, what do you see? Flashing prices. Green and red colors, top movers, trending stocks. This isn't accidental. It's designed to trigger the same dopamine loop as gambling. Like your brain starts asking, what's moving today? What can I buy now? What am I missing? And suddenly, the stock market becomes entertainment. That's when money starts leaving, because the stock market punishes activity. There's data from multiple brokerage firms. The most profitable accounts? Dead accounts. People who forgot their passwords. People who never traded. People who didn't touch anything. The worst performers? Active traders. The more buttons you press, the more money you lose. Reason number 2. The fast money delusion. Most people enter the stock market with the same thought. I just need a few good trades. This is where everything breaks. The stock market is not built for fast money. Fast money exists, but it's someone else's. Usually yours. Every time you chase quick gains, you're competing with algorithms, institutions, hedge funds, People with insider access and speed advantages. You are not late to the game. You're playing the wrong version of it. The market doesn't know you exist. It doesn't care about your bills, your stress, your need for a win. It only rewards patience and scale only comes from time. Reason number 3, time is doing all the work, not you. Here's the part that makes people uncomfortable. Most of the money made in the stock market comes from not doing anything, not trading, not reacting, not panicking, just staying invested. Let's break your brain for a second. If you invest consistently in the stock market for 40 years, over 90% of your final wealth comes from compound growth, not contributions. That means you don't make money early, you make money late. And most people quit before the late part arrives. The first 10 years feel pointless. You invest, nothing exciting happens. Your account looks small, the growth feels slow. This is where most people stop. They say, "This isn't working." But that's because they don't understand the curve. Compound growth is quiet until it isn't. There's a moment where your money starts working harder than you do, where the market adds more to your account in a year than you add yourself. That's when the game changes. But to reach that moment, you have to survive boredom. Most people can't. Here's a brutal truth. Smart people often lose more money in the stock market. Why? Because they overthink. They believe they can optimize everything. They tinker. They adjust. They react. The stock market rewards boring people. The people who win. Invest automatically, ignore headlines. Don't check their accounts daily. Don't panic during crashes. They look stupid in the short term. They look unstoppable in the long term. So if money is really made through patience, why do crashes wipe people out? Why do people panic sell? Why does the market seem designed to scare you? Because the biggest enemy in the stock market is not volatility, it's your brain. And that's what we're going to talk about next. Before we go any further, let's address the question that quietly sits in your head. Okay, but what if the market crashes? Not if, when, because it always does. And this is where most people lose everything. Not because crashes happen, but because they react to them like humans. Here's something no one tells you. And the stock market doesn't move smoothly upward. It moves like this. Long periods of boredom, short bursts of panic, even shorter bursts of euphoria. Most people think money is made during the exciting parts. It's not. Money is made during the boring parts and transferred during the emotional ones. Let's strip away the noise. No opinions, no motivation, just math. If you invest $500 per month into the stock market at an average 10% annual return, S&P 500 historical average, after 10 years, approximately $103,000, after 20 years, approximately $379,000, after 30 years, approximately $1.13 million, after 40 years, approximately $3.16 million. Here's the part that should mess with your head. You only contributed $240,000. The other $2.92 million came from compound growth. You didn't earn it. You waited for it. This is where most people quit. Because the beginning feels stupid. You're investing every month, and the numbers barely move. It feels like, I could just spend this money and enjoy my life. And that thought is why most people never get rich. Because compound interest is backloaded. It rewards patience, not effort. Compound growth isn't linear. It doesn't go $100,000 to $200,000 to $300,000. It goes $100,000 to $110,000 to $121,000 to $133,000 to $146,000. Slow, boring, frustrating. Until suddenly, $1 million to $1,100,000 to $1,210,000. Now your money is adding 6 figures per year while you're still contributing the same $500. That's the flip. And most people never reach it because they quit in the boring phase. 2 people, same market, same return. Person A invests $5,000 per year. From age 25 to 35, 10 years. Total invested, $50,000. stops completely after that. Person B waits until age 35, invests $5,000 per year for 30 years. Total invested, $150,000. At age 65, Person A, approximately $787,000. Person B, approximately $611,000. The person who invested less money ended up with more wealth. Why? Because time beats effort, and the stock market only cares about time. Every year you wait doesn't just delay growth, it multiplies the amount you need later. If you want $3 million by retirement, start at 25 to approximately $500 per month, start at 30 to approximately $690 per month, start at 35 to approximately $1,050 per month, start at 40 to approximately $1,900 per month. The target moves faster than you can catch it, and this is why people panic at 50. Every crash feels like the end of the world. Then 2008 felt like capitalism was over. 2020 felt like society was collapsing, and yet the S&P 500 has returned approximately 10% annually since 1926. That includes the Great Depression, 2 world wars, oil crises, dot-com crash, 2008 financial crisis, COVID still 10%, after inflation approximately 7%, enough to build wealth quietly. The S&P 500 has never produced a negative return over any 20-year period. Not once, not in history. If you stay invested for 20 years, you have always made money. Crashes only matter if you panic. This is the part nobody tells you. If you invest monthly, crashes are discounts. When the market drops 30%, your $500 buys more shares. You don't have to time anything. Dollar cost averaging does it for you. The market falls, you accumulate faster. The market rises, your old shares grow. You win either way unless you panic. The J.P. Morgan studied investor behavior. From 2003 to 2022, stay fully invested arrow $64,844, miss the 10 best days arrow $29,708, more than half gone. Here's the kicker. Most of the best days happen during bear markets. So if you panic sell, you almost guarantee you miss them. The market scares you on purpose. Volatility exists to shake people out. Because every time you sell in fear, someone calmer buys. Money doesn't disappear. It changes hands because of something called loss aversion. Psychology shows losing $100 hurts 2.25 times more than gaining $100 feels good. So when portfolios drop, your brain screams, "Stop the pain," and you sell right before the recovery. Studies show people who check their investments once per year or not at all outperform people who check daily. The less you look, the richer you get. The more you react, the poorer you become. So if the math is this obvious, why do most people still lose? Why do intelligent, hard-working people end up broke after 40 years of work? Why do they panic, overspend, and self-sabotage? Because the real enemy isn't the market. It's how your brain is wired. And in Part 3, we're going to expose exactly how your psychology keeps you poor and who's profiting from it. Let's get one thing straight. The stock market is not your enemy. Volatility is not your enemy. Crashes are not your enemy. Recessions are not your enemy. Your brain is. And not because you're stupid, because your brain was never designed to handle long-term money. Your brain evolved in a world where food spoiled quickly. Danger was immediate, survival meant consume now. There was no concept of retirement compound interest, long-term investing, $500 today versus $3 million in 40 years. So when you try to invest, your brain panics. It doesn't understand future rewards. It understands now. There's a cognitive bias called present bias. It means you value rewards today far more than rewards in the future. So your brain says, Netflix today greater than wealth later, new car today greater than freedom later, eating out today greater than compounding later, even when the math screams otherwise. This is why people say, "I'll start investing later," and later never comes. Your brain treats future money as imaginary. It feels abstract. But $500 today feels real, painful. So you protect the present and sacrifice the future. And not because you're irresponsible, because your brain is bad at math over time. Now, let's talk about the bias that destroys portfolios. Loss aversion. Psychology research shows losing $100 hurts 2.25 times more than gaining $100 feels good. So when markets fall, your brain doesn't see opportunity. It sees danger. It screams, "Get out! Stop the pain!" And you sell, right at the bottom. Crashes don't destroy wealth. Reactions do. The market drops. Your portfolio dips. Your brain activates survival mode. You sell. Then the market recovers. Without you. And suddenly you believe the stock market is rigged. It's not. You just handed your future to someone calmer. Now let's talk about the trap that keeps middle-class people stuck forever. Lifestyle inflation. And every time you earn more, you upgrade, bigger apartment, better car, fancier food, more subscriptions. Your expenses rise at the same speed as your income. So no matter how much you make, you always feel broke. Studies show 78% of people say, "When I get a raise, I'll save more." Almost none actually do, because unless saving is automated, your brain reallocates the money immediately. It says, "We earned this, upgrade life," and wealth never builds. Here's where it gets uncomfortable. Your bad financial behavior? It's profitable. Everyone makes money off your mistakes. Car dealerships love long loans and big payments. Credit card companies love minimum payments. Trading platforms love panic buying and selling. Fund managers love complexity and fees. Advertisers love convincing you that happiness costs money. No one gets rich when you quietly invest in one index fund and ignore it for 40 years. So they'll never tell you to do that. Turn on financial news. What do you see? Markets in chaos. Stocks crashing. Is this the end? Fear sells. Calm doesn't. So they keep you emotional, because emotional people trade more, and trading makes them money. There's a famous study. The best performing investment accounts? Accounts of dead people. Accounts people forgot existed. Zero trading, zero reactions, zero stress, just time. If someone says, "This strategy is complex," run. Complexity hides fees. Complexity hides underperformance. Complexity exists so someone else gets paid. The truth is boring, and boring doesn't sell courses. Let's talk about fees. If you invest $500 per month for 30 years, low-cost index fund, 0.03%, to approximately $1.12 million. Actively managed fund, 1%, to approximately $915,000. Same market, same money. $200,000 plus gone. Not lost in the market, paid to someone else. Quietly, because doing nothing feels irresponsible. Your brain equates activity with progress, but in investing, activity is the enemy. The market doesn't reward effort. It rewards patience. Middle-class people earn good money, work hard, follow rules, and still retire broke. Why? Because they spend decades financing depreciating things, avoiding boredom, chasing short-term comfort instead of buying time. Money can be replaced. Time can't. And the stock market rewards people who convert money into time early and punishes those who wait. So if your brain works against you, the system profits from your mistakes. Complexity is a distraction. Then how do normal people actually win? Not traders, not geniuses, not insiders, regular people, janitors, secretaries, quiet workers. In part 4, we're going to look at real people who beat the stock market by doing almost nothing. And then I'll give you the exact boring, uncomfortable plan that actually works. Let's talk about the people no one interviews on CNBC. No podcasts, no Lambos, no trading screenshots, just quiet winners. Because real wealth is boring to watch. Ronald Reed was a janitor and gas station attendant in Vermont. Never made more than $20,000 a year. Wore a jacket held together with safety pins. He drove a rusted Toyota with holes in the doors. His co-workers laughed at him. They thought he was broke. When Ron died at age 92, his lawyer called the local hospital. They expected a few $1,000s. Ron left them $4.8 million. The library got $1.2 million. His total estate, over $8 million. Ron didn't trade. He bought dividend-paying stocks every single week for decades. Never sold, never panicked, never cared what the market did this month. He could have retired at 50. He didn't, because he liked his job. That's what financial freedom looks like. Sylvia Bloom was a legal secretary in Manhattan. She took the subway to work for 67 years. While lawyers placed stock orders, she quietly bought smaller amounts of the same stocks. No analysis, no predictions. She died with over $9 million and donated most of it to charity. A Grace Groner bought 3 shares of Abbott Laboratories in 1935 for $180. She reinvested every dividend, never sold. When she died at 100, those 3 shares were worth $7.2 million. These people didn't time the market, predict crashes, optimize strategies. They did one thing well. They stayed invested longer than everyone else. The stock market doesn't reward intelligence. It rewards consistency. It rewards patience. It rewards people who can survive boredom. Most people can't. They confuse excitement with progress. Fidelity analyzed millions of accounts. The most common trait of millionaires? Average contribution rate. Approximately 14% of income average time invested, 26 years. That's it. No genius required. Now the flip side. Median retirement savings for Americans aged 65 to 74, approximately $200,000. Social Security pays approximately $1,976 per month. 1 in 5 Americans over 65 is still working. Not because they want to, because they have to. They worked. For decades, they failed because they financed depreciating things, delayed investing. Believed later would be easier, it wasn't. Let's talk about reality. The average new car payment in 2025, $748 per month. That's not a car payment. That's $1.7 million over 30 years at 10% returns. You're trading future freedom for something that loses 20% of its value the moment you drive it off the lot. Every $100 per month invested leads to $226,000 in 30 years. Every $3.33 per day yields $250,000. The money exists. You're just spending it on things that won't exist in 30 years. If you invest $500 per month for 30 years, low-cost index fund, 0.03%, yields approximately $1.12 million. Actively managed fund, 1%, yields approximately $915,000. Same market, same money. $200,000 plus gone, all paid in silence. Fees compound against you. 1. That's it. An S&P 500 index fund. Pick any reputable one. Fidelity, Vanguard, Schwab. They all track the same index. They all cost almost nothing. Complexity is a distraction. Roth IRA. You invest after-tax money. Growth is tax-free forever. On a $1.1 million portfolio, that's $150,000 to $200,000 saved in taxes. 401k pre-tax contributions. Your paycheck drops less than you think. In a 22% tax bracket, $500 invested yields approximately $390 less take home. Employer match? That's free money. Most employers match approximately 50% on the first 6%. Ignore this and you're leaving money on the table. Here it is. No mystery, no hype. Step 1. Open a brokerage account. Roth IRA or 401k. Takes 20 minutes. Step 2. Link your bank. Step 3. Buy one S&P 500 index fund. Step 4. Set up automatic monthly investing. And step 5. Forget the account exists. Don't check daily, don't panic, don't tinker, let the math work. If it's not automatic, your brain will sabotage it. Automation removes choice. Choice is where people fail. Right now, $500 per month for 40 years to $3.16 million. Wait 1 year to $520 per month. Wait 5 years to $690 per month. Wait 10 years to $1,150 per month. The target moves away faster than you can chase it. There's a version of you 40 years from now. They check their account. It says $3.16 million. They're calm, they're free. They don't worry about money. And there's another version, still working, counting prescriptions. One emergency away from disaster. Both are you. The difference? What you do next. The stock market doesn't care about motivation. It cares about time. It doesn't reward excitement. It rewards discipline. And it doesn't punish ignorance. It punishes impatience. You can open the account today and let the math work quietly in the background. Or you can keep spending $500 on things that disappear and wonder where the money went. The stock market will do what it always does. The only question is whether you'll be there long enough to benefit.